SJC-10298, the Gillette Company versus Commissioner of Revenue.
Good morning, Mr. Salinger.
Good morning, and may it please the Court. My name is Ken Salinger. I'm here on behalf of the Commissioner of Revenue. In this case, the Appellate Tax Board erred in ruling that Gillette USA did not dispose of its property within the meaning of the investment tax credit statute when it transferred all of its assets to its corporate parent. We're dealing here with the application of Section 31A, Paragraph E of Chapter 63 of the General Laws.
Could I ask you I guess it is a fact question. I gather from Gillette's brief there was actually, well, two transactions here.
There was a prior merger as well, yes.
And with respect to that merger, which was from Gillette Manufacturing to Gillette USA, right? What happened with the investment tax credits?
My understanding is that because of statute of limitations issues, when that prior merger was discovered in the Department of Revenue audits, there was no attempt to change the tax treatment of that merger, but in calculating the correct treatment with respect to the second merger, the Department of Revenue consistently treated the investment tax credit as being cut off and recaptured at the point of both mergers. So it's a factual question in terms of how the tax implications are actually calculated, assuming that the Commissioner of Revenue's legal position prevails here on appeal.
Do I understand this correctly, though, that when the Commissioner went about trying to sort of put this all together in the audit, when the first merger took place, the Commissioner basically deemed that, I guess it was Gillette USA, didn't get the carryover of the ITC credits, but actually got a whole bunch of new credits for purchasing the facility.
To the extent that the purchase of the facility was now an investment of property, then there was a new ITC at an appropriate basis.
And you say that's a correct analysis of the law?
Yes, Your Honor. That
it's a new acquisition, even though it's a parent purchasing an investment from a wholly owned subsidiary.
That's right.
That would be okay.
Consistent with the rules of separate entity taxation that the legislature chose in 1988 to put into place. There may have been a different result prior to that.
So Emhart notwithstanding, Emhart you say, well, Emhart we would have come out the other way, but that was a different statute.
That's right. The statute in Emhart, which was decided in 1973, differed in two material respects. First, it predated the 1988 statutory change that created this separate entity approach to corporate taxation. And secondly, the tax exemption there, unlike the investment tax credit here, did not have a recapture provision cutting off the exemption when the property is disposed of. So the legislature has subsequently made different policy choices that the board was obligated to respect. The board, pointing to Emhart, seemed to believe that the old tax approach was the better one. But that's a policy issue, and the legislature has made different determinations in its 1988 amendments, both to Sections 31A and 32B of Chapter 63.
Mr. Salinger, what is the legislative policy here that's being implemented?
The legislative policy is that separate tax-paying entities, even if they are related companies, are treated as separate tax-paying entities. And we see that in two material respects. We see that in Section 32B, first of all, that those entities, even if they filed a combined return, have to calculate their taxes separately and independently. And more specifically, in the investment tax credit statute, we see in Section 31A, Paragraph H, a requirement that an investment tax credit of one corporate entity cannot be taken advantage of by a related corporate entity. And so that was what happened here before the merger. Evidently, Gillette USA had these investment tax credits and had not been able to use them all, and that's why they wanted to roll them over to the parent company. Clearly,
but once the merger has taken place, it's not a related company anymore. It's the company.
It doesn't exist anymore. That's right. We're not dealing with the kind of merger. Another thing I should have noted in distinguishing Emhart, this court much more recently in the Macy's East case decided, I think in 2004, talked at some length about the distinction under the Internal Revenue Code between so-called F reorganizations and A reorganizations. That's not at issue here, but the point is the court recognized there are some kinds of mergers that really you start with one company and then it wants to change its form or its state of incorporation or something, so it creates another shell and merges the old company. And you start with one, you end up with one. There's really no change except in the form of the company. That's not what we're dealing with here. Prior to this last merger, the parent, not only did it have a separate legal existence, but it had its own assets, it had its own business. The subsidiary was merged into the parent and it disappeared. But the way that merger was carried out in order to comply with the rules of the Internal Revenue Code is, and this is undisputed, all of the assets of the subsidiary were transferred to the parent. That transfer, as a matter of law, was a disposition. We can tell that by contrasting the Massachusetts investment tax credit with the materially different federal investment tax credit.
But don't we have to look at the corporate or at the legislative policy behind this particular statute, which is to encourage businesses to either move into Massachusetts or expand their operations in Massachusetts? And if we look at that legislative policy, it seems to me that what you're suggesting really sort of creates an unfriendly tax environment for businesses, which is contrary to the legislature's policy.
Your Honor, the legislature's policy is more specific than that because the legislature chose to include paragraph E in Section 31A. They could have not included that provision at all. They could have said there's no cutoff of the investment tax credit in the event of a disposition. Or alternatively, the legislature could have followed the federal model. They could have had the recapture provision, say the ITC disappears if there's a disposition, but we'll make an exception and say that will not happen if the disposition is from a wholly owned subsidiary to its parent as part of a tax-free liquidation and merger. That's what Congress did. They had the explicit exception because it recognized that the general recapture provision, this disposition provision, would otherwise apply in the case of a parent-subsidiary merger. Federal government decided to make an exception for this kind of transaction. The Massachusetts legislature didn't, and it did not make that exception, presumably because it was trying to be consistent with its 1988 decision to basically put to one side a couple of decisions by this court, the General Electric decision and the Walter Kitty decision, that had read Chapter 63 to treat related entities more as a single tax-paying entity. The legislature, for policy reasons, said, no, we're going to separate that out. Now, of course, a few months ago in 2008, effective beginning January 1 of this year, the legislature has made yet another choice with respect to unitary companies. They'll now be required to combine their income and share their credits, and the commissioners in the process of promulgating regulations that, going forward, will answer the question in this case differently yet again. But that's because the legislature is changing the background statutory rules. At the point in time relevant here, December of 1998, the legislature put in place a scheme where separate corporate entities, even if they're a parent and a wholly owned sub, have to calculate their corporate excises separately and may not, under Section 31A, paragraph H, may not share an investment tax credit amongst themselves. Consistent with that, the disposition provision has to be read as being relevant here. We've pointed out that part of the board's error here was in saying, with respect to this difference between the Massachusetts ITC on the one hand and the federal ITC on the other, yes, we see that there's a difference in the statutory language, but for policy reasons, we're going to read the two as if they're the same. The board can't do that.
In this, taking your position, and Gillette, the recapture goes to the company that disposed, as you would put it. What happens to the names are so close, the Gillette company, the merge, the entity that comes out of the merger?
It gets a new investment tax credit of its own. It doesn't inherit the subsidiary's
but it
ITC,
gets a brand new one.
But it gets a brand new one.
So it is treated as though, I mean, if you had a Toys R Us coming in and purchasing this plant, it would be the same thing, you would say. It's a disposal by Gillette USA, and Toys R Us gets the new credit. Is that
That's
right?
exactly right. It seems to be undisputed that if Gillette USA had transferred this property to an unrelated company,
Right.
then it would cut off for Gillette USA, and the new company would get its
And
own
you're
ITC.
saying- And you're saying that's the exact same thing happened here?
Exactly.
Or should happen here?
And it goes to the policy question of Justice Spina. Although the ITC of the subsidiary is being cut off, the parent, for its investment, is getting its own investment tax credit. And so there's not an undermining of the legislative purpose to encourage the investment.
So you're saying Gillette Corp got an ITC that was the equivalent of what was left on Gillette USA's investment tax credit?
I'm not positive factually. I believe in this case the new ITC was essentially the same as what had been left. But obviously we wouldn't be here if it made no tax difference to Gillette. The reason why Gillette had pressed its appeal to the Appellate Tax Board is it is in fact a different tax result to do it one way versus the other.
Now, will it always be that the Gillette-type company loses by your proposition, or may there be times in which the Gillette-type company actually pays less taxes as a result of what you're proposing?
There may well be times where the parent would end up in a more favorable tax situation under what we believe is the correct legal result. It depends on the details of when they're incurring income and what the appropriate basis of the credit is. It's needless to say the tax situation of a company like Gillette is complex. But no, it will not unambiguously cut one way versus the other. It will always depend on the specific facts.
But in this sort of tax-free transaction, Gillette gets the basis, right, for the plant, let's say. The basis is what the subsidiary had.
It was not an issue in this case, and so the record's not so clear. My understanding is it so happens in this case the basis was the same. It's also my understanding.
Which is a different analysis than it would be for purposes of assessing what the level of their new ITC would be under your theory?
Well, in discussing basis, when the parent gets a new ITC, there needs to be a determination of what the basis of the new ITC is.
Ordinarily, that would be the purchase price. You've got a new, unrelated company purchasing asset. It really doesn't make a whit of difference what the other company paid for it.
Originally, that's right.
But here, in this tax-free exchange, isn't the basis that's brought over is the basis of the company that's been merged?
Again, my understanding is that in this case, that's correct. I don't know that in every tax-free liquidation that would necessarily be correct.
Is that an unrelated analysis to the
it is
level of the tax credit that they would get for the acquisition? The ITC? Is it an unrelated analysis?
It's related, but it's not. The basic point I'll make here, Your Honors, is unless Gillette today surprises me and says they accept the Commissioner's calculation of what the result will be, we're not asking the court to do the work of the Appellate Tax Board and figure out a number answer.
No, but it's a general question, I think. I think Justice Court is saying, in that sense, to take my example, Toys R Us and Gillette are in different positions. They both, in theory, get a new ITC, but it may be that Toys R Us is going to have a different and bigger one or something because its basis is going to be a different basis than would be true of Gillette.
And it may be, and I cannot provide the court with more detail, I apologize. It may be that in other tax-free liquidations, there are circumstances that cause the basis to change. The basis calculation can be complex. It was not a disputed issue in this case. The question of remand that we just touched on, unless Gillette is now agreeing with the Commissioner's calculation, we've suggested that, consistent with M&T charters and other decisions of this court, since the Board didn't reach this factual question, if there's a reversal, the case would need to be remanded.
Now, Gillette says, no way. You didn't raise it below, or basically it's a waived point. What do you say to that?
We say two things, Your Honor. They're relying on Chapter 58A, Section 7. We say, first of all, this court should let the board decide that in the first instance.
Whether there's a waiver or not.
That's right. The board had denied that motion previously as moot.
For another, on another ground, right?
That's right. So we have suggested that the board should be allowed to weigh in the first instance. If the court does reach it, however, as we've pointed out in our reply brief, Gillette's argument is basically inconsistent with the statute. The practice at the board is a little bit different than the practice here. Here, of course, if an issue is not raised in an initial brief, it cannot be raised in the reply brief. The rule of Section 7 of Chapter 58A is different. There, the rule is an issue cannot be raised in anybody's brief unless it's first been raised in the petition to the board or the answer. Here, the factual issue about what the calculation is was squarely raised in Gillette's own petition and therefore could be addressed by the board. To the extent that Gillette was raising new legal issues not raised in its petition for the first time in its brief to the board, then the commissioner was certainly, as a matter of law, allowed to respond to them. If Gillette's position is, no, our petition actually raised both the factual and the legal issues, then again, there's no unfair surprise to Gillette. The issues were raised in its petition, and under the statute, the commissioner was free to respond to them.
So your essential argument is that this merger is really is a change in form and ownership, and it is a transfer of assets.
Exactly, Your Honor. And we see that both by looking at the differences between the Massachusetts ITC and the federal ITC, and we see it by looking at Sections 32B and 31AH, where the legislature has mandated this separate entity approach to corporate excise taxation.
Thank you, Mr.
Now,
Salinger.
I'm sorry, one last question. If you lose here, does Gillette keep the ITC that it got and also get the credit back? If
we lose here, then the ITC gets rolled over from the subsidiary to the parent in a way that allows it to be beneficial to Gillette.
But will Gillette also be able to keep the ITC it obtained through its purchase of Gillette USA?
It would not get the new ITC that it obtained, but it would instead be inheriting the ITC from its subsidiary. And the way in which that offsets taxable income differs enough that Gillette does not want that result. Thank you, Your Honors.
Thank you. Mr. Brown.
Thank you, Your Honor. This is the 1970 investment tax credit statute that we're interpreting. These later enactments in 1988, we are told, inform us with respect to 1970. This is a tax incentive statute which is intended to encourage Gillette to make investments in Massachusetts. The reason you get a deficiency under the Commissioner's theory is because you take an investment tax credit times your original cost. Now, the original cost here that Gillette invested in the factory in South Boston was some $560 million. It invested it, and you get a 3% investment credit against that. But the way they're applying after the recapture, what they're saying is, in a rather strange result, that you get new investment credits in Gillette, but that's 3% times the then depreciated basis. So that's why you come up with this $5 million deficiency. Now, what happened here? Gillette Manufacturing, a second-tier subsidiary, owned a factory in South Boston. It invested $250 million in equipment to manufacture shaving products. That company then merged in a tax-free merger into Gillette USA. Gillette USA in the year 1998 goes on and invests another $312 million in the factory. And then at the end of 1998, it merges into Gillette Company. Those mergers are tax-free. The tax basis in the property carries over. The accounting method carries over. The depreciation methods carry over. And I say the ITCs carry over under federal law. And that law is the same as the Massachusetts statute. There is no disposition, as the board found, calling for a recapture. This is a penalty for Gillette. $600 million of investment. They've changed the form of their ownership from one wholly owned subsidiary to another wholly owned subsidiary and then into the parent. And the department is claiming that's a disposition.
Well, let me ask you this, though. Mr. Salinger says that our law is actually different than the federal law because there is a specific provision in the federal law that says tax-free exchanges under Section 3, whatever it is, aren't covered by this.
Federal law does have a specific provision that Section 381 transfers, which this is under federal law. you do not have any recapture. The board said that rule is incorporated into the Mass statute because it is a sensible rule in this circumstance, and there's no basis, there's no clear indication from the legislature that they ever intended to deviate from it. This court faced the same question in Emhart. In Emhart, you had an incentive statute which said that you get exempt property by the reason of the increase in investments after 1962. Emhart had subsidiaries which had investments in Massachusetts, but they were made before 1962. They liquidated them into the parent, and the taxpayer said, I get new ITCs because I've now acquired this property in 1963 and 1966. This court, Justice Browker, said no. The statute has to be read it has to be read in light of its purpose. Its purpose was to encourage investment. When you have a tax-free reorganization, you're not increasing investment in Massachusetts. The investment is constant, just as with Gillette. The investment in the South Boston factory never changed. It never increased. It never decreased. There's no reason to recapture. There's no decrease. And there's no reason to give new credits. It never increased. And that is the purpose behind the statute. That was all of the same. Justice Browker went directly to Justice Botsford's point in Emhart. It said, well, you could read the statute to say we didn't incorporate the federal rule, the federal ITC rule. It was the same federal statute. We didn't incorporate a tax-free carryover in the federal statute. And you could read it to say, well, in that circumstance, there's not going to be, we're not going to allow any credit, any exemption, if there were one. And then he rejected it. He said no, but that would defeat the purpose of the statute. The statute is not intended to give credits or take them away if you're not changing your investment in Massachusetts. And he pointed out there was neither an increase nor a decrease, and therefore the taxpayer could not get additional credits.
Mr. Brown, I heard you start right off at the beginning saying that we're looking at the 1970 statute, and so whatever statutory amendments were made in 1988 don't go to an interpretation of the 1970 statute.
Let me revert to that. The so-called separate entity edifice, which has been created, is based on this court's decisions with respect to the Massachusetts net operating loss. That's part one. And then part two, some specialized statutes dealing with combined returns. This court in Macy's East concluded that under the particularized Massachusetts NOL statute, you could not carry over a net operating loss from one company to another. This court did it based on a regulation that was in point, which said that you did not carry over. On the contrary, here, there is no regulation saying that you do not get a carryover. And it also based it on a strict construction of a strict construction approach to the statute where a taxpayer is claiming an exemption. That strict construction was rejected by this court for tax incentive statutes, which Justice Browker said had to be fairly construed and reasonably applied to promote the welfare of the state by encouraging people to invest. No such principle would apply with respect to net operating losses.
Have there been any amendments since 1970 to the particular statute that applies here?
Any amendments to Section 31A? No, Your Honor. No. I'm coming to the other point. The board said that it rejected the analogy to the net operating loss cases because of the particularized history of the Massachusetts net operating loss, which has always deviated from the federal from day one. From 1933 on, our statute has said we do not allow the federal net operating loss, and we have adopted our own Massachusetts net operating loss, and the statutes just deviate. By contrast, in this case, the Massachusetts investment credit statute was copied from the federal statute. That's a complete departure from the Massachusetts NOL. The NOL statute...
But it did leave out this very relevant provision.
It did not pick up this specific point, but this court has always said we incorporate federal law unless we find a clear indication of it for a departure.
Well, why isn't the fact that the federal law has a specific exemption for this a departure?
Because no one has been able to cite any legislative history or anything else to indicate that the legislature ever thought about it or ever intended to deviate. the other states, Rhode Island and New York, have exactly the same statutes. They've both interpreted them for no disposition with respect to a tax-free carryover in a merger.
And what was the basis of that ruling by the other states?
Those were regulatory pronouncements by the...
Yeah,
Well,
was the
they
basis
did
for
it
that?
both by ruling and by regulatory pronouncement. But they are logical. This board adopted them and said they are the logical interpretation of the statute. That if you look to the purpose of the statute, it just makes no sense to have a recapture.
Despite the omission of the federal language?
Well, but you can't. How much? There are many cases, such as the Franchi case, where we incorporate federal concepts that were not specifically incorporated in our statutes. The omission is not an indication of a departure, unlike the NOL statute, where we have a statute which says we don't follow the federal law. We generally incorporate the federal law. The appeals court's case in Bank Boston incorporated the federal law with respect to dividends, even though there was no indication. There was no indication that we incorporated that law. Dividends received deductions. So the other statutory amendments, which my brother referred to, were the amendments to Section 32B in 1988. There were two of them. One had clarified that for 32B purposes, each company computes its own income on a separate company basis, and in 31H, it specified that when you file a combined return, you can't use the investment credit of one company against another company. On the other hand, the board said correctly that does not bear on the question of do you carry over ITCs in a statutory merger of a subsidiary into the parent. There's no mass law that says you don't carry over ITCs in a statutory merger. There was a mass regulation which says you don't carry over NOLs, but there's no regulation here.
Now, Gillette Company was 100% owner of Gillette USA here, I gather, correct?
You say again, Your Honor?
Gillette Company was the 100% owner of
Yes,
Gillette USA.
it was 100% owner of both subsidiaries.
Would the result be different if Gillette Company were a 99% owner of Gillette USA?
No, it would still be a tax-free liquidation under federal law and therefore under Massachusetts law.
So as long as it holds a majority of the shares, it's sufficient?
Well, you have to own 80%.
So 80%.
80% is the benchmark.
So it's treated as if it is not a disposition, even though there's a transfer.
Well,
20% of the shareholders actually are different from the parent company.
if you have 80% ownership, there's no disposition because you have a tax-free merger. You carry over your adjusted basis. Nobody should be getting any new credits. There's no new investment, and you shouldn't be revoking prior credits because the same factory, the same employees, the same investment, and that was this court's decision in Emhart.
But if Schick had bought the company, there would still be no new investment. They simply would be purchasing the existing plant and using the existing plant.
If you have a taxable transaction, then you have a recapture because then you're getting a new basis. The basis carries over. They invested $560 million. After depreciation, that basis carries over to the parent. If someone else, when Procter & Gamble buys Gillette, that's different. That's a taxable transaction. You're stepping up the basis from whatever it is to the value then being paid.
And what's the impact of that on the tax credits, the investment tax credits? In other words, when the basis changes, as you say.
When the basis changes, that would be a taxable transaction,
understand
and that
that.
would be a recapture event.
But what's the, I guess this is the question, what is the relationship between the basis and the calculation of the ITCs?
The ITC is 3% times the basis of the property.
Okay, so if Schick bought, it would be 3% of whatever that purchase price was.
Yes, 3% of the purchase price as allocable to the South Boston factory would be the,
And there'd be a recapture against the seller.
against the seller, and a new ITC for the buyer. Now, giving new ITCs in statutory mergers is very likely to lead to a fair amount of tax avoidance. I mean, one of the problems is going to be this: the ITC has a limited carryover period. If you have a 3-year period for carryovers, when you have expiring ITCs, time to liquidate the subsidiary into the parent, The expiring ITCs will offset the recapture, and the parent will get a new ITC 3% times the adjusted basis. It's not going to be a rule that the department likes. This rule that you get new ITCs every time you have a tax-free reorganization.
Does the
It like it.
I'm sorry.
I'm sorry.
No,
go
no,
ahead.
no, no.
Go
You
ahead,
finish.
Justice. Please.
I was going to ask you a different question, so finish what you were going to say.
No, I'm finished.
Okay. Mr. Salinger mentioned that as of 2008, I guess, or 9, anyway, there's been a change, I guess 8, change. Does that inform us at all about how we should be interpreting 31AE?
I don't see any relationship. We've just gone to a different system of combined reporting. This statute, when they talk about the intent of recapture, 31E is part of 31A. You can't read what is the purpose of 31. If you ask yourself, well, what's the purpose of 31E, which says that you have recapture and disposition? Well, you have to ask yourself then, all right, that's not a separate statute. That's part of 31A. What's the purpose of 31A? That's how you read 31E. If you carry out the purpose of 31A, which is to encourage investment in Massachusetts, then you won't find a disposition in a tax-free liquidation. The board also found support. It found support for its position, as I mentioned before, that the Massachusetts statute was modeled on the federal statute. It said that the rules in the federal statute were logical in connection with tax-free reorganizations, and therefore it found that as an affirmative reason to adopt those rules, just as New York did, just as Rhode Island did. New York and Rhode Island have interpretive regulations. Interpretive regulations can't make changes in statutes.
And I take it that the New York and Rhode Island statutes are similar to the Massachusetts statute.
Essentially identical. The Massachusetts statute was in fact copied from the New York statute. With New York enacted its statute in 1969, 1 year before Massachusetts. Massachusetts copied the New York statute.
How old is the federal statute?
The federal statute was 1962. We had the exemption system. We also enacted an exemption system in 1962, the one that was in MHART, which where you get an exemption for property for increased investment after 1962, and you carry it forward for 5 years. And that is the most informative case for this situation, how you fairly treat a tax incentive statute.
Thank you, Mr. Brown.
Thank you.